If you just started trading and if you're looking for a winning strategy to trade, I prepared for you 4 simple and profitable Forex trading strategies for beginners. All of the strategies work on any Forex pair. You can trade gold, oil and silver with them, and you can trade the strategies on any time frame. Please don't forget to like this video, subscribe to my YouTube channel, and let's start. Strategy number 1, the Harmonic Strategy. With that trading strategy, you will trade harmonic patterns. To properly apply a harmonic trading strategy, you should learn just 3 things. You should learn the Fibonacci levels, Fibonacci retracement, and Fibonacci extension. You should learn the numbers, the rules of the harmonic patterns, and the exact ratios. And you should learn the impulse lag identification. Here are 3 powerful harmonic patterns that I recommend you to start with. The first one is Godly pattern. Trade bullish and bearish harmonic Godly pattern. Trade bullish and bearish harmonic bad pattern, and trade bullish and bearish harmonic cipher pattern. The strategy is very simple. Each harmonic pattern is based on 4 consequent legs of the movement: X to A to B, B to C, and C to D legs. And the type of the pattern will depend on Fibonacci levels. You should measure the retracement level of each point of the pattern, and with that you will identify the type of the harmonic pattern. The completion point of the pattern, D point, will give you a very accurate point to buy or sell the market from, depending on the type of the pattern. That strategy is very simple, and your rule is to identify the impulse lag, and based on the impulse lag, recognize one of the harmonic patterns. Wait for the completion point of the pattern and trade it following the rules. Strategy number 2, the trend following strategy. And that strategy is based on classic, simple price action rules. To properly apply that trading strategy, you need to learn to identify the price action legs, and you should know the rules of the market trend identification. According to our classic rules, we say that the market is trading in a bullish trend if we see at least 2 consequent bullish impulses and a retracement leg with the higher low between them. And we say that the market trend is bearish if we see 2 consequent bearish impulses and a retracement leg with the lower high between them. Traders, learn how to trade in my premium group. Get the access to my daily live streams with live trading and analysis. Get my ebook and video course explaining to you my trading strategy. For more info, check my website. It is vasilitrader.com/private group, or text me in one of the social networks. I will give you more details. Once you spotted that the market is trading in a bullish trend, you should patiently wait for a formation of a new high. After that, pay close attention to the level of the previous high and the level of the last higher low. That will be the zone, the area from where you should buy the market. That will be the area where you should set your buy limit order and from where you should anticipate a bullish continuation. With that strategy, you buy the market from that area, setting your stop loss below the last higher low, and your take profit will be the next strong horizontal resistance. And if you spotted the market that is trading in a bearish trend, let the price set a new lower low. After that, monitor the area based on the level of a previous low and the level of the last lower high. That will be the area from where you should look for shorting. That will be the area from where you should sell the market, expecting a bearish movement to the new low. Shorting the market from that area, set your stop loss above the last lower high, and your take profit will be the next strong support. When you apply the trading strategy, recognize the price action legs first. You can see that Aussie Swiss started to trade in a bearish trend on an hourly time frame, and you can see that we have a bearish impulse retracement and a new bearish impulse with the formation of a new lower low. That is the signal for you to watch the area based on a previous low and the last lower high. That will be the area from where you should short. You can see that the price retested that point. Shorting from here, set your stop loss above the highs, and your target is the next strong support. So that is how your trade would look like. That strategy works on any time frame. However, I recommend applying that strategy at least on a 4-hour time frame or higher, and higher is the time frame higher will be the accuracy of that trading strategy. Strategy number 3, the Breakout Strategy. This strategy is structure-based, and your task will be to learn to identify support and resistance, key levels, supply and demand zones, and the trend lines. The better you identify the key structures, the higher will be the accuracy of your trades. Here is the structure analysis that I executed on Euro-Yen pair on a daily time frame. You can see that here I have underlined key supports, key horizontal supports and resistances, and I also underlined the vertical support, the trend line. After you spotted key structures, your task will be to wait for a breakout of one of those structures. If you're looking for a breakout of resistance, you will need a daily candle close above that, while if you're looking for a breakout of support, you will strictly need a daily candle close below that support. You can see that here Euro-Yen violated our resistance and closed above that. After the breakout, the broken structure turns into support. That will be the area from where you can buy the market. Buying the market on a retest of a broken structure set your stop loss beyond that, and your take profit should be the next strong structure. Being applied properly, that strategy will demonstrate very high win rate. And again, even though that strategy works on any time frame, my recommendation to you to trade that strategy at least on a 4-hour time frame or higher. And this strategy reaches the highest accuracy on a daily time frame. Strategy number 4, the trend reversal strategy. And that strategy is very simple. It is based on simple price action rules, and in order to trade that properly, you should learn the rules of trend identification and the rules of trend change and trend reversal. According to classic price action rules, we say that the market violates a bearish trend when the price violates the level of the last lower high and closes above that. Then in order to confirm the trend change, we will need the retracement, the formation of a new higher low, and the consequent bullish impulse with a new higher high. When we see the price action like that, we see that the trend is no more bearish and that it is now bullish. The same logic will be applied with the bullish trend. The main focus will be the last higher low, and if the price violates that and closes below that, we will see that a bullish trend here is violated. Then in order to confirm the trend change, we will need the retracement, the formation of a lower high, and then the consequent bearish movement and the formation of a new lower low. When we see the price action like that, we see that the trend is no more bullish and that the trend is now bearish. When you spotted the initiation of a bullish trend, your buy zone will be the area based on the previous high and the higher low. That will be the area from where you should buy the market. While in order to catch a bearish trend continuation, your sell zone will be the area based on the previous lower low and the lower high. That will be the zone from where you can short expecting a bearish trend continuation. Take a look at the pound New Zealand pair. Here we have a great example of a confirmed bullish reversal. You can see that the pair was trading in a bearish trend. The market was setting new lower lows and lower highs. However, once that low was reached, something changed. And you can see that then the price bounced and we violated the level of the last lower high, setting a new higher high. Then we retraced and set a higher low, and after that we formed a new bullish impulse with a new higher high, higher close. So that a bullish reversal here was confirmed. After a confirmed bullish reversal, your perfect buy zone will be based on the level of a previous high and the level of the last higher low. Here is your buy zone from where you should buy the market. You should set your stop loss below that area and you should anticipate a bullish continuation. What I like about all these strategies is that while you are practicing the strategies, while you are trading with the strategies, you learn price action analysis, you learn the trend analysis, you learn the identification of the impulse lags, you learn the structure analysis. All these components are essential elements of the sophisticated professional trading strategies. Moreover, you can modify these strategies, and with experience, With practice, you can add extra layers of analysis, probably apply the multiple time frame analysis, and make the strategies better and better. Let me know, traders, in the comment section which strategy do you prefer. Also, let me know if you have any questions. If you want to learn how to trade, do not forget to check my premium group, the link in the description below, and traders, do not forget to watch my other videos.